Okay. So very good afternoon to all the esteemed dignitaries and participants. I am CA Anant Vora, founder and CEO of Dreamform, having 10 years of experience specializing in Zoho-based digital finance systems and financial advisory and scalable accounting solutions. On behalf of the members in Industry and Business Committee, I extend a warm welcome to everyone present today. Members in Industry and Business Committee of the ICAI serves as a strategic bridge connecting chartered accountants in the corporate and government sectors with the institute. Its primary mission is to enhance professional leadership and global positioning through executive education, high-level networking forums, and deep engagement with industry regulators. So I would like to now introduce our chairman, Mr. CA Dr. Anuj Goyal. Chairperson, he is a Central Council member of ICI and a chairman of the members in Industry and Business Committee with over 30 years of professional experience, holding multiple qualifications including CA, CS, CMA, LLB, MCOM, PhD, DISA, and DIRM. He has served in various leadership roles across ICI and contributed extensively to research, publications, and professional development initiatives. Next, I would like to introduce our Vice Chairperson, CA Preeti Paras Savla. CA Preeti Paras Savla is a Central Council member of ICI, Chairperson of the Corporate Laws Committee, and Vice Chairperson of the Members in Industry and Business Committee of ICI. She serves internationally on the ISSB Sustainability Standards Advisory Forum and holds governance roles including Public Interest Director at NSE Clearing and Independent Director for leading companies. Next, I would like to introduce Mr. CA J.K. Jain. CA J.K. Jain is a senior chartered accountant and former chief manager at UCO Bank with 38 years of experience in corporate credit, risk management, and banking finance. I request CA J.K. Jain, sir, to please present the opening remarks for the session.
Thank you, Mr. Vora. Myself, J.K. Jain, respected Chairman Sir CA Anuj Goyal ji, Vice Chairman Mrs. Preeti Paras Savla ji, our today's speakers. It is my privilege on behalf of the members in Industry and Business Committee of the ICI. It is my pleasure to welcome you to today's webinar regarding capital gain tax issues in assessments and appeals, with a dedicated focus on the evolving framework of the Income Tax Act 2025. Capital gains taxation remains a critical focal point for professionals in the corporate sector, particularly as we navigate an era of heightened regulatory scrutiny and sophisticated litigation. Staying abreast of these shifts is essential for maintaining robust compliance and informed decision making within our respected organizations. The introduction of the Income Tax 2025 marks a significant milestone, bringing forth revised provisions that directly impact corporate restructuring, slump sales, securities transactions, and the administration of ESOPs. This session has been strategically designed to offer practical insights into the complexities faced during the assessment and appellate stages, while providing a comprehensive roadmap for the new legislative landscape. By examining key risk areas and documentation requirements, our goal is to empower members with the best practices necessary for effective tax planning and risk mitigation. We are confident that the deliberations today will yield valuable perspectives and actionable knowledge tailored specifically for members in industry and businesses. I encourage each of you to participate actively and engage with our experts to maximize the technical value of this session. With these opening remarks, I extend my best wishes for an insightful and intellectually enriching program. Thank you. Thank you.
Thank you, JK sir, for setting the perfect context for today's session. This webinar is part of our ongoing series, The Industry Conversations, where we aim to bring practical insights and discussions relevant to professionals in industry and business. Next, it is now my privilege to introduce our distinguished speaker for today, CA Bhimanshu Kansal. He is a chartered accountant and an advocate with over 10 years of experience in income tax and international tax litigation. He is the founder of Kansal Bhimanshu Legal, a regular speaker at ICI forums, and an author on minimum alternate tax. He is also a recipient of the FIT Fellow 2023 award. We are truly honored to have you with us today, sir. Today's topic for discussion is capital gains tax issues in income tax assessments, appeals, and capital gain provisions under the Income Tax Act 2025 for members in industry and business. This is a highly relevant and evolving area, especially for professionals dealing with compliance assessments and litigation. Handing over to speaker, without taking much time, I would like to now request CA Bhimanshu Kansal sir to kindly commence with his deliberations. Over to you, sir. Sir, Bhimanshu sir, you can unmute yourself.
Goddess Saraswati, respected Anuj Goyal sir, Chairman, members in Industry and Business Committee, ICI, respected Preeti Madam, CA J.K. Jain sir, Anant Vora ji, Mukul Singhal ji, and other office bearers of this committee. Thank you so much for providing me this opportunity. So, background about me, and capital gain taxation has always been an area of advisory and litigation also, because income tax authority always wanted to check what is the period of holding that the assessee has taken into consideration while filing income tax return, whether income has been shown under the correct head of income or not. Also, whatever deductions have been claimed by the assessee in terms of section 54, 54F, etc., whether these are legitimate claim or not. So there are various aspects capital gain taxation. So considering that it's always been a area of litigation from the perspective of
Hello, Kansal sir.
I think there was certain network issue from my side. Hopefully, I'm audible now.
Yes, sir, you are audible.
Okay. So I just repeat what I mentioned earlier, that capital gain taxation has always been area of litigation, because tax authority want to have a check on period of holding, legitimate claim of deduction under section 54, 54, etc., and the correct head of income under which the taxpayer has shown his income. So these are the aspects which generally tax authority want to check. So if we talk about, we need to see what is the basis of charge of capital gain taxation, which is provided and delineated under section 45 of Income Tax Act 1961. The provision says that any profit and gains arising from transfer of a capital asset shall be chargeable to tax under the head capital gain in the previous year in which transfer took place. So if we read this definition, so there are certain words which require emphasis. First of all, capital asset, and second is the transfer. Because there is no doubt that if there is any profit and gains on sale of capital asset in the nature, until unless an asset is capital asset in nature, so that profit and gain will not be taxable under the head capital gains. Second important word is transfer, because there are various factors which need to be taken into consideration while analyzing the event of transfer. That can be giving the possession in the capital asset, that can be the registry of immovable property, or that can be an enjoyable rights also. So considering that, we need to keep in mind and we need to identify with a very mindful mind, in a mindful manner, that what is the event of transfer, because the charging section says the capital gain will be come into picture in the year in which transfer took place. So if we understand this transfer, both are well defined under the provisions of Income Tax Act. Capital asset is defined under section 214 of Income Tax Act, and transfer is defined under section 247 of Income Tax Act. Capital asset defined as like property of any kind held by assessee, whether this is connected with business or not. Second is that if there is any securities which are held by foreign institutional investors in accordance with the provisions of SEBI, so that shall also be tantamount as capital asset. Third and very important, and for which the amendment has been made in 2021 and in 2025 also, unit linked insurance plans, which is called as so that also has been considered as capital asset as per if we talk about personal effects, so that will not come into definition of capital asset. But if this is the case of jewelry, drawings, painting, etc., then this will be coming under the definition of capital asset, and accordingly, sale of tax under the head capital gains. So as I mentioned, the definition of capital gain, and as I have read also, property of any kind held by the assessee. So if we read the word property, so that is defined and interpreted by the courts. Property can be movable property, property can be immovable property. So if we talk about movable property, so that can be like rights, copyrights, leasehold rights, etc. But if we talk about immovable property, so movable property can be shares also, also. But immovable property includes, like mentioned, that immovable property is also the part of capital asset. So definitely there are assets, which I should say, that can be leasehold rights, tenancy rights. So these can be considered as capital asset. So definition is very wide because property includes movable, immovable, tangible, intangible. All type of assets can be defined and come under capital assets. As I mentioned, we know that immovable property are well understood by way of land and building. We can also understood the movable property like jewelry, shares, etc. But if we talk about intangible assets, so what type of intangible assets are there which can be considered as capital asset, and the sale on account of those assets will come into taxation of capital gains. So for example, we book a flat. Nowadays, many people book a flat launch price
Hello,
or
Himanshu sir.
after launch price also. So the builder gives rights in that immovable property. Registry can be happened at later stage. Possession can be given at later stage. But yes, Anansi, you want something? Hello.
Himanshu sir, there is a
Anansi,
bit
you
of
were saying
net.
something.
Yeah, Himanshu sir, there is bit of network fluctuation maybe at your end. That is why the voice is not coming clearly to the participants. If you can just check the connection and refresh it.
Wi-Fi is proper at my end. So I try to be loud also.
Yeah, it is better right now. We can continue.
Okay, thank you. So what I was saying that as I mentioned that there are certain intangible capital assets, the sale of which can come into the taxation of capital gain head. So rights in immovable property can also be tantamount as capital asset. For example, nowadays people book a flat at pre-launch price, or it may be the scenario that after launch also they book a flat, but registry can be happened at later stage, possession can be granted at later stage. So whether that right which have been given by builder to investor, whether that will be tantamount as capital asset. So yes, because intangible assets is also the part of capital asset. So sale of those rights to another person will come into the tax net of capital gain head. Second illustration which may take from the decision of Supreme Court in the case of Vodafone. So what happened in that scenario, that there is a foreign company which has subsidiary company in India. The shares of foreign company has been sold outside India itself. So since the value of shares of foreign entity was derived through
Himanshu sir,
Indian
Himanshu sir,
entity because
there is no clarity in the audio.
that foreign entity was doing business here.
Himanshu sir, can you hear me? Vivanshu sir, we cannot hear you actually. Vivanshu ji, you try switching off your video. Maybe it will help us have the better clarity on audio.
And Anandji, what I'm saying that Wi-Fi is proper at my end, but I just turned off my video. It may be better
Yeah.
then.
Yeah, you can turn off the video. Sure. Thank you.
Okay. So another example, I just repeat in the interest of participants, that there was a Supreme Court ruling in the year 2012 in which the foreign entity had a subsidiary company in India. Foreign entity run its business in India. So the shares of that foreign entity have been sold to another non-resident. So the contention of the assessing officer was in that case, and that was the case of Vodafone, and that traveled till Supreme Court. So contention of the assessing officer was that since foreign entity was running business in India, so the value of shares of foreign entity was somewhere influenced from India itself. So whatever sale consideration of that foreign entity on account of its sale of its shares, that shall be taxable in India. But Supreme Court has decided the matter in favor of the taxpayer, stating that since the assets, which is shares, were situated outside India, and sale were also made by that foreign entity outside India itself to another non-resident entity, so that shall not be taxable in India. Assessing officer wanted to tax it based on intangible value of those shares. So considering that Supreme Court ruling in 2012, there was an amendment brought into Act stating that if there is any indirect transfer, so that shall be chargeable to tax in India, and that was retrospectively effective from 1962. So I just wanted to mention that intangible assets can also be held as capital asset, and that accordingly that can be taxed in India. Now, for example, I'm just taking certain examples based on judicial pronouncement. There are certain shares in an Indian company, and basis those shares and which are kept as stock in trade, there were certain right debentures have been issued to the assessee. That can be called as intangible asset, and that will be coming under the definition of capital asset and will be chargeable to tax. Sometimes it happens that assessee gives right to someone to develop a land. So a question comes into consideration that owner is different and the person is having only rights to develop that land. So whether sale of those rights will come into the picture of capital gain, and accordingly the sale consideration on account of sale of those rights will be tantamount as capital gain taxation. So answer is yes, because right to develop a land is intangible asset, and that will be considered as capital asset. Now, taking another example, and which happens also, a foreign entity which gives loan to its subsidiary in India, and for example, that Indian entity become into a consideration and into financial crunch. So considering that situation, these debts and the loan are sold at a loss. So can we consider it as a capital asset, and whatever the sale consideration which is received to the assessee, in comparison to what loan has been given can be considered as a capital asset. So in 2023, in the case of Siemens, Supreme Court has held that if any loan has been given by a parent entity to Indian entity or Indian subsidiary entity, and the value of that loan is reduced just because of Indian entity is in loss, so that will be considered as capital asset, and whatever loss is incurred by parent entity, that will be allowed as capital loss under the head capital gain chapter. So idea was just to explain you that generally we see that land building is there, jewelry is there, so these are definitely come into consideration, and that comes directly into definition of capital asset. But what can be other assets also, like intangible assets, which we should also consider while analyzing the capital gain taxation? Now there are certain examples which can be called that these does not fall under the definition of capital asset. And what can be those examples? Let's suppose a company has given a contract to another company, but another company has not fulfilled its responsibilities within the time period. So considering that company A is eligible to get the damages, the right to claim damages is with company A. So since there are intangible assets in this scenario also, because there are certain rights in relation to claim of damage, so whether that will be tantamount as capital asset? So answer is no, because right to claim damage is non-transferable rights in view of Transfer of Property Act. So whatever consideration is received on account of this damage claim will be considered as capital receipt, and that shall not be chargeable to tax. So this is an example of intangible asset, but this will not fall under the definition of capital asset. Now, another point in relation to capital asset itself, that at the time of transfer, the nature of asset should be capital asset. For example, I mentioned that capital asset includes the urban agricultural land. This does not include agricultural land. So, for example, in the year 1980, Company A has purchased a land which is agricultural land. But at later stage, that company has developed certain housing sites on that agricultural land. Acquisition, the nature of asset was not a capital, but at the time of transfer, since this is a capital asset because that company has developed housing sites on that agricultural land, so that will be tantamount as commercial asset, and accordingly the chargeability will come under head capital gain. So we need to see what is the nature of asset at the time of transfer, irrespective of the fact what is the nature of asset at the time of acquisition of that asset. Another example which we may see, and it happens also practically, that Mr. A purchased a land 50 years ago, and in today's time, considering the value of land, he has decided to develop villas on that land and sold it to investors and residents also. So since the nature of that asset was agricultural land at the time of acquisition, but we need to see the nature of that asset at the time of transfer. So now we may see that Mr. A has sold those assets after developing villas, so that will be considered as commercial property, and that will be considered as capital asset and will be chargeable under the head capital gain. An important word, I'm reading ahead the definition of capital asset, and as I mentioned, that property of any kind held by the assessee. So another important word is held by the assessee. And the meaning of held can be different from the ownership. So for example, Mr. A is owner of a property, but Mr. B is having leasehold right in that property. So we should consider this fact that rights in that property is with Mr. B in terms of leasehold rights. So we may say that asset is held by Mr. B in today's time, and accordingly chargeability may come in the hands of Mr. B. So if we understand this thing with certain examples, let's add certain rights in land and building from Mr. B. And please note transferred. Only rights in land and building has been transferred. So considering that, can we see that Anantji, I believe so that I'm audible now.
Yes, you are audible now.
Okay, so I'm saying that if a company is having rights in land and building, so that may also be considered as capital asset held by the assessee. So if Mr. A transferred those rights in land and building to Mr. C, so whatever sale consideration will be accrue or arise in this case, that shall be chargeable under the head capital gain. While computing the tax under the head capital gain, as per judicial pronouncement, it is utmost required to see the intention of investment and so see the intention of holding that capital asset. So it may be the scenario that a broker is having certain shares. Certain shares can be stock and trade for him, but certain shares can be investment for him. So with what intention he is carrying those shares, that is required to be checked here, and accordingly capital gain taxation will come into picture. I just give you one example. A bank is having a land, and that land is shown in the balance sheet of bank as a fixed asset. The bank sell that fixed asset at a later stage. So can that be tantamount as sale of stock and trade, or that can be tantamount as sale of investment? So Bombay High Court in this case has decided, since the business of the bank is not to acquire the land and sell those land, so accordingly, irrespective of the fact that bank hold that asset as fixed asset, the taxation will not come under a business head. If there is any profit or gains accrue or arise on account of sale that land, that shall be tantamount as capital gain taxation. Another example I just want to put here, that Mr. A purchased an agricultural land. Mr. A died, and considering the huge size of that land, the wife of Mr. A has sold that land in part and parcel. So since wife of Mr. A has sold the land in part and parcel by making plotting, so can that be considered as business income, or that can be considered as a capital gain taxation? So the High Court has analyzed in this case that what is the intention to sell that land into part and parcel. Mr. A has invested in that land as a agricultural land, but considering the situation, because land was used and wife of Mr. A was unable to sell that land in one go, so considering this facts and circumstances, she sold that land in part and parcel. So court has decided that intention is clear, that this is not the business as such. This is the case of sale of capital asset, and accordingly capital gain taxation will trigger in this case. We may see that in past there was certain litigation, and today is also, that if certain shares are sold and assessee want to tax it under the capital gain head, officer want to tax it under business income. If assessee tax it under business income, then officer want to keep it under capital gain taxation. So this is always been a area of litigation from taxpayer and tax officer side. Now I'm reading further the definition of capital asset, and as I mentioned, that there are certain exclusions also in the definition of capital asset. So one is stock and trade. Second one is personal effects. So personal effects can be car, apparels. So if assessee sell those personal effects, that will not be considered as capital asset, and there would not be any taxation on account of that under the head capital gain. But there are certain exceptions also to personal effect. For example, jewelry. In case of sale of jewelry, there have been dispute and matter have been raised to High Court also. So for example, assessee purchase certain utensils. So can that be considered as jewelry and will be taxed under capital gain head, or that will be considered as personal effect? There are certain facts which need to be analyzed in this scenario. We must see that utensils of gold and silver are used for what purposes. Let's suppose assessee uses those utensils of gold and silver not in ordinary course but at some occasions. So it may be considered that these are of personal effects. Accordingly, there would not be taxation on sale of those utensils under the head capital gain taxation. Now, another factor which we should consider in this case, what is the quantity of utensils? Because if assessee is using those utensils for his own purpose, so there should be certain limit of utensils. But if there are substantial quantum of those utensils, so it may be considered that assessee has purchased those utensils for the purpose of investment itself. So court has decided in that scenario that if quantity is used, so that shall be the case of investment, but not the case of using those utensils for personal purpose. In one more case, the assessee has purchased certain utensils for Lakshmi Puja. So whether that will be considered as capital asset or that will be considered as asset used for personal use. So court has decided, since utensils have been purchased for Lakshmi Puja, so that will be considered as investment, and accordingly utensils will be considered as capital asset, and sale of those utensils will come under the ambit of capital gain taxation. Now coming to stock and trade, and we may see that shares sale of shares will be considered as business income or capital gain area of litigation. So, in this regard, from time to time, CBDT has brought certain instructions, CBDT has brought certain circulars and clarifications also. So, first of all, at very first time, CBDT has issued certain instructions in the year 1989. And CBDT mentioned that if certain assets and shares are held as stock in trade, so sale of those shares will come into business head income. But if assets is held as an investment but not as a stock in trade, in that scenario, the sale of those shares will come into capital gain head taxation. This is the instruction which is given by CBDT. And also it has been mentioned that assessee need to prove that under what form these assets and shares have been held by the assessee. That is the responsibility of the assessee to prove before the assessing officer. So for example, scrutiny happened and assessee is unable to prove that under what category these shares are held. So whatever claim has been made by assessee in his income tax return, the assessing officer has taken different contention, and matter become litigative, and matter reached to ITT and the High Court. So thereafter, in 2016, issued a circular in this regard to eliminate the litigation, and CBDT has explained that in case there are certain shares which are kept as stock in trade, so irrespective of period of holding, that will come under capital gain under the business income taxation. But for example, if any shares is held for more than 12 months, then as per the discretion of the assessee, and a caveat has been added by CBDT that if assessee consider it as capital asset, then he will take the consistent approach in future, and all such asset will be coming under the head of or under the tax of capital gain. So again, the purpose was not fulfilled. So CBDT has clarified in May 2016 itself. CBDT has come with circular in February 2016, and at later stage in May 16 itself, CBDT has clarified that if there are unlisted shares which are held for more than 12 months, irrespective of the fact these are held as stock in trade, the assessee can consider that as also capital asset, and capital gain taxation will be applied upon sale of those shares. So, considering all these litigations and all, CBDT tried to reduce the litigation, but this is these instructions, clarifications, circulars have not fulfilled the purpose. So somewhere there are mixed judgments which are pronounced basis facts, that what is the frequency of sale of those shares, what is the period of holding of those shares. So these are factors somewhere to analyze whether the transaction will come into net of business income or transaction will come into net of capital gain taxation. Somewhere in today's time, it is clear that if any asset, any shares is held as stock in trade, that shall come into net of business income. But if there's any asset which is held as investment, that shall be chargeable under the head capital gain taxation, irrespective of period of holding. So this is somewhere in relation to capital asset definition, what is included, what is excluded, what type of litigation is there, what can be succession, what Supreme Court, High Court has decided. So all these are in relation to capital asset. One more point I just wanted to mention here in relation to ULIP, because that impact to many taxpayers. In 2021, it is mentioned that ULIP will be considered as capital asset unless this is exempt under section 1010D by virtue of fifth and fourth proviso under section 1010D. So what is the fourth and fifth proviso was that if any investment or premium is made of more than 2,50,000 rupees, so in that scenario, this will not be exempt under section 1010D. So the issue under consideration was that, for example, it is a 10-year process. In 9 years, the payment of premium was less than 2,50,000, but in 10th year, the premium was more than 2,50,000 by whatever reason, because there can be multiple ULIPs or there can be other factors also. So this matter has been considered by CBDT, and the words "on account of fourth and fifth proviso" was eliminated by Finance Act 2025. So in today's time, the situation is that if any ULIP does not come under the exemption under 1010D, which says that if premium is not exceeding 10% of sum assured, then in that scenario, the taxation of ULIP will come under capital gain tax. So in relation to capital asset also, the last point is in relation to agricultural land. Agricultural land is not considered as capital asset. So accordingly, sale consideration on account of sale of agricultural land is not come under capital gain taxation. But we need to see that what is the nature of agricultural land, whether this is rural agricultural land or urban agricultural land. If this is the case of urban agricultural land, then this will definitely be taxable under capital gain tax. So in relation to agricultural land, there are certain factors which we need to analyze again. For let's take an example that there are two agricultural land. One is held by Mr. A, another one is held by Mr. B. JK Jain sir, can you please confirm that now I am audible?
Yes, Kansal sir, you are audible.
Okay. So let's suppose Mr. A, Mr. B having agricultural land and both are adjacent land. Mr. A has constructed certain villas on his property and sold to another person's. So definitely, as we discussed, that though that is agricultural land at the time of acquisition, but at the time of transfer, since there are commercial construction have been done on that, so that will be considered as business income, and that shall be considered as capital asset, and that shall be taxed under capital gain taxation. But that does not impact the agricultural land of Mr. B. If Mr. B sell his agricultural land as it is, without any further construction, without any plotting, etc., then this is not the factor that since the land of Mr. A is taxed under capital gain, so Mr. B land will also be taxable under capital gain. Both lands are independent. Nature of both land need to be analyzed separately. In relation to agricultural land, we need to see population also of municipality. If the population of municipality is less than 10,000, then this will not be qualified as urban agricultural land. This will be qualified as agricultural land itself. Another factor which we need to consider is the distance from municipality, and we need to factor in the population also as per last census, which was in 2011. So if population is more than 10,000 but up to 1 lakh rupee, then distance of 2 kilometer need to be seen here. If population is more than 1 lakh rupee but less than 10 lakh, the population is more than 10,000 people but less than 1 lakh people, then in that scenario 2 kilometer distance need to be seen here. 6 kilometer distance need to be seen where population is more than 1 lakh people but less than 10 lakh people. And if this is the kilometer distance need to be seen. So first we need to see aerial distance and then we need to see population factor. Basis that it will be decided whether land is agriculture or this is a rural agricultural land or urban agricultural land. Nowadays we may see that there are various notices which have been issued to taxpayers. They sold certain land and under an impression this is agriculture land, they have not filed their income tax return properly. So either this is the case of scrutiny assessment under section 143 or this is the case of reassessment proceeding under section 147. So while handling these proceedings, we need to see what is the nature of agricultural land, what is the nature of land in the particular case of assessee, and accordingly response need to be filed before the assessing officer, because this is somewhere factual before the assessing officer. Now coming to another important word, we somewhere understood what is the meaning of capital asset, and we have seen there are various factors which we need to consider while taxing any capital asset. Now another factor is transfer, because this is also an important factor that under which year the taxability will arise. There may be scenario that Mr. A and Mr. B they have executed a agreement to sell in relation to sale of any property, but property is registered at a later stage. It may be the scenario that registry cannot be happened due to certain reasons, but possession is given. So transfer word is also defined under Income Tax Act. There is inclusive definition under section 247 of Income Tax Act 1961, which defined word transfer. And if we understood transfer, so we may understand in a common parlance that if any property is conveyed to another person, that may be called as a transfer. But somewhere law is also need to be seen while deciding whether this is the case of transfer or not. So for that purpose, we need to refer section 247. 247 defines the word of transfer as sale, exchange, relinquishment of rights. At later stage, the law evolved, and that includes the possession also, because what happens that Mr. A is transferring a land to Mr. B, possession is given, but registry is not done. So since registry is not done, so considering that capital gain will not be, this will not be the case that tax will be levied as a capital gain taxation. So considering that definition of 247 has been amended and the word possession is also being added under the definition of transfer. So by amending that definition, let's suppose Mr. A gives possession of a building to Mr. B, irrespective of the fact the registry is done or not, that may tantamount as transfer, and capital gain taxation may come into picture in that scenario. Another word as per section 247 itself is enjoyable rights. And what is the meaning of that? Let's suppose Mr. A has taken a building from Mr. B and without any interference of Mr. B. Mr.
Hello. Himanshu sir, can you hear me?
Himanshu sir, can you hear me?
Yes. So, what I'm saying, hello.
Hello.
In relation,
Himanshu ji, we can not hear you actually.
transfer there are judgments which concerns that transfer can be happened at the time of agreement to sale. Yes, registry is done, then there would not be the case of transfer. So there are multiple factors, and importantly, we need to read the language of memorandum of understanding between both the parties, the agreement to sale, registry, arrangement between both parties. So these factors are very important to decide that what is the date of transfer. Since there was an amendment in relation to transfer and the date was, so I just recall Finance Act number 2 2024, wherein there is a date 23rd July 2024. By that Finance Act, it was mentioned that the property which have been transferred before 23rd July 2024, the taxation will be as per the different aspect, and where there is a transfer on 23rd July or after, on or after 23rd July, in that scenario, the rate of capital gain tax will be different. So I believe so that officer will like to check that whether correct period of holding has been taken, especially in financial year 24-25. The correct nature of asset has been analyzed by the taxpayer. This is short-term capital asset, long-term capital asset, and correct tax treatment have been given as per the capital gain tax provisions. So I'm hoping that especially for financial year 24-25, that tax officers would like to check in relation to capital gain tax treatment given by taxpayer in their income tax returns. Now, as I mentioned, that claim of deduction under section 54, 54F, etc. is also a area where generally in the income tax return where these deductions are claimed, so there is an scrutiny notices. So first we need to understand what is the law in relation to section 54, 54F, etc. And then we need to see that what is the conditions in relation to those sections, whether these are satisfied and properly met by the assessee to claim those deductions or not. So if we talk about section 54, so the conditions is that there should be a residential house which need to be sold by assessee, and another residential house need to be either purchased or constructed by that assessee itself. Another consideration, another condition is that debt capital asset should be long term in nature. Third and very important is that the new asset should be purchased either 1 year before, or that should be purchased 2 years after the date of sale, or that should be constructed within the 3 years from the date of transfer. If these conditions are not satisfied, then in that scenario, if a person who has claimed deduction under section 54, that may be disregarded or declined by the assessing officer. There are certain other factors also which comes into litigation in that scenario. For example, Mr. A has sold a residential house, but another residential house have been purchased not only in the name of assessee itself, but under co-ownership with wife of assessee also. So it is a matter of analysis and checking from the assessing officer point of view that would that be the scenario and eligibility criteria to claim deduction under section 54. Another aspect is in case of purchase after 2 years from the date of transfer or construction after 3 years after the date of transfer, assessing officer also want to check, because nowadays in the income tax return we need to furnish information that what is the date of transfer, what is the date of purchase, what is the date of construction. So in that scenario, tax authority want to check that if any sale consideration has not been utilized by due date of filing return of the previous year in which that asset has been sold or transferred, whether that capital gain has been deposited into capital gain account scheme or not. Although there are certain judicial pronouncement which says that deposit under capital gain scheme is not a criteria to decline the deduction of the assessee. Ultimately, if assessee has utilized the sale consideration to acquire and construct the new asset in the form of residential house, that then in that scenario, assessee is eligible to claim the deductions. Another scenario is, as I mentioned, that if assessee has purchased or constructed new property or new building, residential house, not only in his name, but in the joint ownership with his brother or wife or father or brother, sister, etc. So in that scenario also, judgment says that ultimately utilization of that sale proceeds need to be checked in that scenario. Ultimately, considering family situations, if assessee has purchased new asset under joint ownership with his wife, so that scenario also the deduction under section 54 should be allowed. Four to 5 years ago, there was an amendment in relation to section 54, and that is very important to highlight here, that if capital gain, because 54 one of the condition under section 54 is that assessee need to construct or purchase only one house, one residential house. So what was that amendment was that, let's suppose assessee is having capital gain up to 2 crores rupee. So in that scenario, there is a liberty to purchase or construct not only one house, but in that scenario, one house will be replaced with two houses. And that is once in a life option available with the assessee. So there are two conditions here. One is capital gain is up to 2 crores rupee, and second point is that this is a lifetime option. In that scenario, the capital gain is invested not only one house but in two house. In that scenario also, deduction under section 54 will be allowed. One more amendment in relation to 54 which has been done recently. There is a cap to claim the deduction under section 54. So deduction under section 54 can be claimed up to 10 crores rupee only. So if there is any capital gain, for example, of 14 crores, and that is invested in new house, irrespective of the fact that entire capital gain is invested in new house of 14 crores rupee, the deduction will be limited to 10 crores. Similarly, if we read the provision of section 54F, so that talks about that residential house need to be purchased, but sale of capital asset should be other than residential house. So if assessee is selling shares, jewelry, etc., and he is purchasing new asset in the form of residential house, in that scenario, deduction will come under section 54F. And there are certain conditions also to claim deduction under section 54F. First of all, that there should be asset other than residential house. The residential house should be purchased either 1 year before the date of transfer, or this should be purchased within next 2 years from the date of transfer, or that should be constructed within 3 years of the transfer. So if these conditions are met, then assessee is eligible to claim deduction. A major difference between the deduction of 54 and 54F is that under section 54, the investment of capital gain need to be made to purchase a new residential house. But in case of section 54F, the investment of net consideration need to be made to claim deduction under section 54F. Another point is that at the time of purchase of new asset, the assessee should not be having more than one house in his name at the time of transfer. So these are the major conditions to claim under section deduction under section 54F. And likewise, section 54 in 54F also there is a threshold of 10 crores rupee, and there is no rollover benefit. So for example, as Mr. A has sold jewelry of 18 crores rupee. He purchased a new residential house of 19 crores rupee. So this cannot be the scenario that in year 1, Mr. A has made the payment of 10 crores rupees, then he will be eligible to claim deduction under section 54F in year 1 of 10 crores rupee. And since he is making payment of 9 crores in year 2, so he would be eligible to claim deduction of 19 crores in 2 different years. The aggregate deduction in this case would be up to 10 crores rupee only. So these are the basic conditions in relation to 54F. But important point here is, and which comes into consideration, that Mr. A has sold jewelry, but new asset have been purchased not only in the name of Mr. A, but under joint ownership with any family members. So would that be considered as the investment into new residential house? And the assessee would be eligible to claim deduction under section 54F. And this is a major point which comes in relation to 54F only. So there are mixed judgments which says that assessee is eligible for deduction under section 54F, irrespective of the fact a new residential house is purchased by assessee under joint ownership of any family members, especially where assessee is purchasing new residential house under joint ownership with his wife. In that scenario, High Court says that assessee is eligible for deduction under section 54F. But if this is the case of brother or sister or mother or father, then definitely there are certain negative judgments also, which says that in that scenario, deduction will not be allowable if new asset have been purchased under joint ownership. So in that scenario, only the proportion of assessee, the investment in the proportion of assessee will only be allowed under section 54F. Now, I just want to move on a slide, which I just want to show as I does the amendment by Finance Act number 2, 2024. So I just want to explain something. Sir, please let me know if my screen is visible.
Yes, sir, your screen is visible.
Okay. So I just give a background of that amendment by Finance number 2 Act 2024. The amendment was that if any asset had been sold before 23rd July 2024, then in that scenario, indexation benefit will be available to the assessee. And where the asset has been sold on 23rd, on or after 23rd July 2024, in that scenario, indexation benefit will not be allowed to assessee. There were certain discussions, and accordingly, there is an exemption given in the case of certain assessees in case of certain assets. So what type of that certain assessees were? There are two type of assessee which are still eligible to claim the benefit of indexation, irrespective of the fact the asset has been sold on or after 23rd July 2024 also. But that asset should be purchased before 23rd July 2024. So if I summarize in a way, in case of individual resident, resident individual, resident at HOA, if land and building is purchased before 23rd July 2024 and that is sold after 23rd July 2024, then in that scenario, these two assessees which are individual resident HOF are eligible to claim either they can benefit of indexation. So special provision for them, they can opt that. And building, that option is available. Has purchased jewelry before the in today's date, he will not be allowed to claim benefit of indexation. So I just give you certain examples that under what circumstance still assessee being resident individual and resident HOF is having an option to claim the beneficial provision. So first column is showing considering the indexation benefit. Full value of consideration of sale of land and building is 6 crores rupee. And without consideration of indexation benefit also, the sale consideration is same. But if assessee does not opt indexation benefit, then definitely whatever is the cost of acquisition that need to be considered as it is, which is 1.5 crore. So if we see right side column, since indexation benefit is not claimed by the assessee, so in that scenario, we may see that capital gain is 4.5 crores. But since assessee, I'm just repeating this point again and again, that assessee being a resident individual, resident HUF, he just want to see that what is the benefit applying the indexation. So in that scenario, the cost of indexation, index cost of acquisition comes 5 crore 44 lakh 50,000 rupees. So what is the beneficial provision for him to apply the indexation benefit? But we need to see that if assessee applies indexation benefit, so in that scenario, the tax rate would be 20%. Vis-a-vis, if assessee does not apply indexation benefit, then in that scenario, the long-term capital gain on sale of land and building would be taxed at 12.5%. So I am just moving to another example, and we need to see this example from the perspective of deduction under section 54. Full value of consideration is 6 crores rupee. Cost of acquisition is same 1.5 crore. So index cost of acquisition is again as per the last illustration. So what I just wanted to highlight here, that long-term capital gain is same what I have shown in last slide. But here, since this is the residential house case, so to claim deduction under section 54, so what is the beneficial provision for assessee is to take the benefit of indexation. Because what's happening that if long-term capital gain is 55 lakh rupee, then he may invest only 55 lakh rupee and can utilize the other amount. Vis-a-vis, if we see the column of right side, where no indexation benefit is taken by the assessee, so what is the capital gain? That is 4.5 crores. And to claim deduction under section 54, he has to invest 4.5 crore. So I think participants can understand what I'm trying to say, that this is not only from perspective of tax planning, but this is also from perspective of financial planning. In option 1, I can invest only 55 lakh 50,000 rupee and can utilize balance amount as per my choice. But in second scenario, somewhere I need to invest a higher amount to claim deduction under section 54. I just change this example from section 54F perspective, because you remember I mentioned that in the case of section 54, we need to invest capital gain. However, in case of 54F, we need to invest net consideration. So the numbers are same. Full value of consideration is 6 crores. Cost of acquisition is 1.5 crore. Index cost of acquisition is 5.44 crore. And amount of capital gain is again same, 55 lakh in considering the indexation benefit. 4.5 crore is without considering indexation benefit. So we need to see that what is the proportion of capital gain to net sale consideration as per formula given under section 54F. So what is the amount of investment? I need to see this is the proportion 9.25 in first scenario, 75% in second scenario. And what is the amount which I am investing for exemption? That is 3 crores rupee. So I can see that in that scenario, under section 54, the option 1 is beneficial for me. But if I talk about section 54F, then option 2 is beneficial for me, because I can claim exemption of higher amount, which is 2.25 crore. So if Mr. A has sold jewelry of 6 crores rupee and he want to invest that net sale consideration into residential house, then applying the option as per right side column, he can invest up to 2.25 CR, and he would be eligible to claim amount of 2.25 CR. Now, this is another example which I just want to put here. That sale of the date of purchase is 1995, date of sale is 2024. So of course, period of holding is more than 24 months. So this is the long-term capital asset. So whatever is the gain, that will be long-term capital gain in my case. Now cost of acquisition is 3,60,000 rupees. So if I apply the benefit of indexation, so index cost of acquisition come 13,06,000 rupees. However, if I does not apply the indexation benefit, so cost of acquisition will remain intact, which is 3,60,000 rupees. So in first case, what is the long-term capital gain? That is 1 crore 36 lakh rupee vis-a-vis 1.46 CR if I don't apply indexation benefit. So it looks attractive that long-term capital gain is less where indexation benefit is applied. But we should go ahead to it. We should apply the tax rate on that and need to see what is ultimately my capital gain tax liability, because you just need to keep in mind that if you apply indexation benefit in that scenario, the tax rate would be 20%. However, if you don't apply the indexation benefit, then in that scenario, tax rate would be 12.5%. So in next table, I have calculated the capital gain tax on that. So on 1 crore 36 lakh rupee, if I apply 20%, because I have taken indexation benefit, so long-term capital gain tax comes 27 lakh rupee, which is higher in comparison to long-term capital gain without applying the indexation benefit, because in that scenario the tax rate is lesser than the tax rate under the indexation benefit. So if I apply 12.5% on 1 crore 46 lakh rupee, then tax comes 18 lakh rupee. So this is beneficial provision. Now I'm just going ahead and analyzing this example from deduction under section 54 perspective. In scenario 1, where assessee has taken indexation benefit, the assessee is making investment of 1 crore to 20 lakh rupee to purchase a residential house. So in that scenario, long-term capital gain, which is remaining after making investment under section 54, that comes 16 lakh rupee. Vis-a-vis 26 lakh rupee if I don't apply the indexation benefit. But again, I need to see what is the tax coming to assessee, what is the tax liability to the assessee. So if I apply 20% on indexation benefit, so that comes 3,38,000, which is higher if I compare the long-term capital gain tax on 26 lakh rupee applying to 12.5% capital gain tax rate if assessee is not opt to the beneficial provision of indexation. Hope I am making clear here. Now, giving the scenario 2, that instead of investment of 1 crore 20 lakh rupee, I am making investment in residential house of 1 crore 30 lakh rupee. So in that scenario, remaining amount with after investment would be 6 lakh 93,000. Vis-a-vis 16 lakh if I don't opt indexation benefit. In this scenario, even I apply the higher tax rate, which is 20% on long-term capital gain. This is beneficial situation for me because applying 20% on 6,93,000, the tax liability comes 1,38,000. However, if I apply 12.5% on long-term capital gain, which is coming without applying indexation benefit, the tax liability is higher. So in case of resident individual, resident HUF, I need to see that what is the beneficial provision for me. I don't need to be limited till capital gain, I need to see what is my capital gain tax liability. I need to go further. I need to see what is the investment which I am making, what is the amount I am claiming as a deduction under Section 54, and ultimately what is my tax liability in my country. In this example itself, for example, my capital gain under option 1 is coming 1 crore 36 lakh rupees. In option 2, the capital gain is coming 1 crore 46 lakh rupees. But if I am making investment of, let's suppose, 1.5 crore to purchase a new house, then it doesn't matter whether I am opting indexation benefit or I am not opting indexation benefit. There would not be any tax liability, because entire capital gain, even whatever is my capital gain, in excess of that, I am making investment in view of Section 54. So I need to see the provision not only from tax perspective but also from finance perspective. What is the beneficial provision for me? Because in subsequent years also, this benefit or this option will be available in case of resident individual and resident HUF in case of sale of land and building. Now, I'm just touching certain provisions in relation to Section 50C, which talks about the fair valuation on sale of capital asset being land and building or both. So we may understand that the provision of Section 50C talks about that if there is any sale from the assessee side and the stamp duty value is somewhere on a higher side, whatever is the sale consideration. So I need to take sale consideration as stamp duty value. And for that purpose, there is a 10% safe harbor also, that, for example, the consideration, whatever consideration is received to assessee and whatever is the stamp duty value. So if sale consideration does not exceed 110% of stamp duty value, then in that scenario, there would not be any implication of Section 50C. So with an example, I just cleared this. The stamp duty value of a property is 100 rupee. However, assessee has sold that property in 90 rupee. So apparently we may see that the difference is of 10% rupee, 10%, but I need to apply this 10% on sale consideration. So in my example, sale consideration is 90 rupee. So I need to see 110% of sale consideration, which comes 99 rupee. 90 plus 9, that comes 99 rupee. Since stamp duty value is 100 rupee, so in that scenario, I need to take sale consideration as 100 rupee, which is stamp duty value. If I modify my example and sale consideration is 91 rupee, and if I calculate 110% of 91 rupee, so that comes 100 rupee 10 paisa. So since the difference is not exceeding 10% of my sale consideration, so in that scenario, 91 would be my sale consideration, irrespective of the fact that stamp duty value is higher, because I am taking benefit of 10% safe harbor in this case. In case of 50C itself, I need to see that whether I am selling land or building or I am selling rights in land and building. Because rights in land and building are different from land and building. So if a company who is having only rights in land and building, and that company is transferring further only rights in land and building ownership with some other person or government authority, so in that scenario, the provision of Section 50C will not be applicable. So I just to clarify this thing with an example. Company A has sold certain rights in land and building of 1 crore rupee. However, stamp duty value of that land and building is 1.5 crores rupee. So in that scenario, since company is transferring only rights in land and building, but not the land and building. So considering that provision of section 50C will not be applicable here, and accordingly, sale consideration need to be considered as 1 CR by the company. And in relation to 50C itself, I just want to mention one more point, that the safe harbor, which is 10% in today's time, that was earlier 5%. So court has decided that 10% need to be applied retrospectively. So if there is a case of sale of transfer in prior years also, and matter is pending before any court, the assessee can take the benefit of 10% in prior years itself. Now, coming to next point in relation to sale of shares under IPO process by the promoters. And there was an amendment in last Finance Act also in this regard. So what happened that, let's suppose promoters hold certain shares and company is being listed. So in the process of offer to sale, those promoters have to sell certain shares. So in that scenario, there was certain ambiguity in the law, because in 2018, there was an amendment in the law, major amendment, by way of which section 112A was inserted. And the sale of those listed shares were taxable under section 112 capital A at the rate of 10%. And there are conditions also while applying the provision of section 112A. The first, it should be long-term shares. Second, there should be security transaction tax at the time of transfer. So for example, Mr. A, who is a promoter of company ABC, holds certain shares since year 2017. And in the year 2023, he is offloading his shares by way of offer to sale in view of IPO process. So in that scenario, I need to refer section 55 to AC to see what is my cost of acquisition need to be considered, need to be taken into consideration. Because I am satisfying the condition of 112A. The asset is long term, and by way of Finance Act 2004, I have to pay security transaction tax also in view of offer to sale. So I'm meeting the condition of 112A, but I need to see what is the cost of acquisition as per section 55. So if I see section 55, it talks about certain circumstances where I need to take cost of acquisition given under section 55 to AC, which says that in case of unit, this is the cost of acquisition. Since these shares are not the unit, then this provision will not be applicable on me. Second, it says that the share should be listed at the time of transfer. So this is also not the case, because at the time of offloading that share, the company is not listed. The third condition is that I need to see the value as being the listed shares as on 31st January 2018. Since the company was not listed and on the recognized stock exchange on 31st January 2018, so I cannot take in these circumstances the cost of acquisition as per section 55 to AC. So since one leg is missing in this case, I cannot take the cost of acquisition. So there was an ambiguity that in that scenario, what is the cost of acquisition I need to take in this case. So Act was amended, and with retrospective effect, it has been clarified that in such a scenario, what is the manner to compute the cost of acquisition. So it has been decided and it has been inserted in the provision. Capital subclause A has been inserted under section 55(2) AC, which says that I need to apply indexation as per the cost inflation index and accordingly need to compute cost of acquisition. So let's suppose I have acquired shares in 2016 at 100 rupee in the year 2016, and I am selling those shares in the year 2023. I need to apply cost inflation index as per year 2023 by taking base as 100 rupee in the year 2016. So in this manner, I will be able to take the cost of acquisition and accordingly I need to compute capital gain. Just two more point here, and thereafter I'll conclude myself and will take further queries. So what is the recent amendments in relation to capital gain taxation? And second is that what is the provisions which are changed by way of Income Tax Act 2025? So first of all, if I talk about the amendment by Finance Act 2026, and that is implemented in Income Tax Act 2025. First of all, the taxation on buyback of shares is amended. Earlier, what was happening that if a company purchase its own share by way of buyback process, so in that scenario, whatever is the consideration is to be received by the shareholder, that need to be taxed as dividend. But now provisions have been changed. In such a scenario, the tax liability is shifted from dividend to capital gain taxation. So if a company is buying its own shares by way of buyback process, then in that scenario, whatever is the sale consideration is received to shareholder, that will be chargeable to tax under the capital gain head tax. A corresponding amendment has been made under the dividend provision that in such a scenario, dividend taxation will not be applicable. Now, what would be the tax rate in this scenario? That is another aspect need to be understood. If this is a case of sale of listed shares, then the tax liability will be computed as 20%. If this is the case of sale of short-term shares but unlisted shares, then in that scenario, the tax liability will be computed applying the normal provisions of that. And if this is the case of sale of listed shares and this is the case of long-term capital asset, then the tax rate would be 12.5%. So the normal tax rate, which is defined otherwise in the capital gain tax provision, that shall be applicable. However, an important point to note here is that if promoter is a company, then in that scenario, some additional income tax need to be levied. So, and in case of company also, there are two bifurcation. First, if promoter is a domestic company, then additional income tax rate would be different. And if this is the case of foreign company, the foreign company is the promoter, then additional income tax rate is different. But if I summarize, then in case of domestic company, if domestic company is the promoter, then in that scenario, the tax rate would be 22% by adding additional income tax. And if this is the case of foreign company, then tax rate by adding additional income tax, the tax rate would be 30%. So for example, if I elaborate this, if this is the case of short-term capital asset and shares are not listed, then the provision, applicable provision, normal provision will be applicable. So that comes itself 30%. So in that scenario, there would not be any additional tax. So ultimately, the point is that if this is the case of individual promoters, then tax rate would be 20% or applicable rate or 12.5%. But if this is the case of company, then in case of domestic company, the tax rate would be 22%. And in case of foreign company, the tax rate would be 30%. The second change is in relation to gold schemes. Earlier, what's happening that if Mr. A is purchasing gold under the scheme notified by the government, and by way of any reason, person other than Mr. A is selling those gold, so somewhere that is still eligible for the benefit under capital gain tax. But now it has been amended that original owner should be the selling person, then only the benefit of capital gain exemption will be applied in that scenario. Now coming to Income Tax Act 2025. So I'll take only 5 minutes maximum to explain the Income Tax Act 2025 change, because if I talk about from the policy perspective, if I talk about from the intention perspective, there is no change as such in the Income Tax Act 2025. The provisions are same as far as capital gain taxation is concerned. If I or the basic the charging provision which I have read initially, so the definition is same. Only the difference is that notwithstanding has been replaced with irrespective of the fact. The previous year has been replaced with tax year. So principally the provisions are same, but how to interpret the change of language, that need to be seen. So I just give you one example here, and I'm just sharing my screen for that perspective. Anantaji, just let me know if my screen is visible.
Yeah, your screen is visible.
Okay, so I'm just reproducing the section 50C here. So left side is section 50C as per Income Tax Act 1961. Right side is corresponding section 78 as per Income Tax Act 2025. And this section is in relation to taking the fair market value as so I need to take the full value of consideration as stamp duty value if stamp duty value is higher than the sale consideration. So the earlier provision was that where the consideration received or accruing as a result of transfer by an assessee of a capital
Hello.
asset being land or building or both. Hello.
Hello.
Yes, Anandji, I am audible.
Yeah.
Hello.
Sorry. Yeah, you can continue.
Okay, so I'm reading it further. Is less than the value adopted or assessed or assessable by any authority of state government. So I'm stopping myself here. I'm just emphasizing on the value adopted, assessed or assessable by any authority of a state government here. So somewhere, if we look at Finance Act 2009, so this assessable word has been inserted at that point of time, because let's suppose there is a transfer of a capital asset being a building by way of power of attorney or without registry, in which the role of stamp duty value does not come. So in that scenario, neither this is the stamp duty value which is adopted nor the case of assessed. So the intention of the government was that if something which can be accessible also by any authority of a state government, that need to be taken into consideration for the purpose of stamp duty authority, stamp duty valuation. Now, if I am reading the corresponding provisions under Income Tax Act 2025, it says if the consideration received or accruing from the transfer of a capital asset being land or building or both, is less than the stamp duty value. So here the words assessed, adopted, assessable is missing. So apparently we may see that the purpose of adding the word accessible is somewhere missing here. Though we may see that intention would be same of the government. The policies are same. There is no change in the act. But if we literally read the provision of section, since accessible word is missing here, even adopted and assessed is also missing here. Because if there would be an stamp duty value, then definitely assessed and adopted will automatically will there. But if there would not be the case of applying the stamp duty value provisions, then accessible is missing there. So we will see that how need to be interpreted. So somewhere principally the things are same, but we need to take into consideration that how the law, the language of law, which is simplified, need to be read in future. So somewhere this is from my side. I can take up questions from the participants. Anandji.
Sure. So thank you so much, sir, for an insightful and comprehensive session. I'm sure all the participants found it extremely informative and practically useful. So before we move on to the question and answer, I would like to
Sir,
introduce.
can
Yeah, just a
can
minute.
can I
Yes,
also
yes.
see the questions? Is if possible?
Yeah, I can share the questions with you. Just give me a minute. Yeah. So we have our chairman, sir, with us today in the webinar. So let me introduce our chairman, Mr. CA Dr. Anuj Goyal. He is the Central Council member of ICAI and chairman of the members in industry and business committee. With over 30 years of professional experience holding multiple qualifications including CA, CS, CMA, LLB, MCOM, he has served in various leadership roles across ICAI and contributed extensively to research, publications, and professional development initiatives. I would request CA Anuj sir to say few words regarding the committee and today's session. Over to you, sir.
Good evening,
Okay,
sir. Sir, you are on mute.
Okay, Anuj sir may join us in few minutes. So Consult sir, by the time we can start the question and answer, and in meanwhile, Anuj sir may join us in the webinar. Yeah.
I
Okay,
cannot see the questions.
just a minute, I will just read out the questions for you.
Okay.
Yeah. So we have some live questions. So question number one is, there is an anomaly in the income tax provisions with regard to indexation benefit to non-resident assessees under various provisos to Section 48 of the 1961 Act. Is this addressed in the new Act 2025?
So now the point is that there would not be any indexation benefit in relation to non-residents because the provisions were already been amended by Finance Act 2024, which says that if any asset will be transferred after 23rd July 2024, then in that scenario, indexation benefit will not be available. Indexation benefit will be available only in case of resident individual, resident and individual HOF, in case of sale of
Hello.
make
Kansal sir, your audio is not clear.
non-resident. So this case now, there would not be any indexation benefit available to the non-resident.
Okay, Kansal sir, you can hear me?
Yes, I can hear you.
Okay. The audio was not clear in between. Maybe few words were missed by the participant.
Should I repeat what
Yeah,
I
if you can
mentioned?
just, yeah. It would be better if
Okay,
you can
so
repeat.
what I'm saying that the White Finance Act 2024, the law has been amended, and if there would be any transfer of any asset by the non-resident, then indexation benefit will not be applicable in that scenario. So similar thing is in the case of finance, the income tax at 2025. So in case of non-resident, there is no case of applying indexation.
Okay. So we have the next question.
Hmm.
How can capital gains tax structure be further simplified?
So in that regard, I think government has tried to make it simple in earlier provisions also. Like they have removed the indexation provisions. They have kept the simple tax rates that in case of long-term capital gain, this would be, if this is the case of listed shares, the rate would be 10%. In case of non-listed long-term capital gain, this is 12.5%. In case of short-term capital gain on listed entity, listed equity shares, this is 20%. So somewhere indexation was one of the thing which was somewhere government thought to make it simple. Otherwise, the Income Tax Act is always be litigated because it is not easy to read the Income Tax Act. And as I was reading in my slide also, like accessible word was earlier, and there was an intention to add that word. Now, since that word is not added in Income Tax Act 2025, so somewhere litigation will always be happen when we interpret and read any law.
Sure. Thank you, Kansal sir. Yes, Chairman sir is there with us in the webinar. I would like to introduce Chairman sir again. So CA, Dr. Anuj Goyal, he is the Central Council member of ICAI and Chairman of the Members in Industry and Business Committee with over 30 years of professional experience, holding multiple qualifications including CA, CS, CMA, LLB, MCOM, PhD, DISA and DIRM. He has served in various leadership roles across ICAI and contributed extensively to research, publications and professional development initiatives. I would request Chairman sir to speak few words regarding the committee and the webinar that is made.
Thank you very much, CA Anant Vora ji, Honorable Moderator, and all the respected dignitaries present here. We are having CA turned advocate Bhimanshu Kansal ji, who is a very prominent spokesperson, and today he is taking a very important topic, capital gains tax issues in income tax assessments, appeals and capital gains provisions under Income Tax Act 2025 for members in industry and business. We are having the presence of CA Mukul Singhal ji, who has been the corporate member of Committee for Members in Industry and Business and has contributed in a great way for the cause of the members as a very prominent member, corporate member of the Committee for Members in Industry and Business. We are having our very senior chartered accountant, ex-banker, CA JK Jain ji. I welcome on behalf of Institute of Chartered Accountants and Committee for Members in Industry and Business, and of course CA Anant Vora ji, and we are having our Honorable Secretary of the committee, CA Anita Suneja ma'am, who is contributing in a great way day in day night. She is trying to see that how we can really do something very concrete for our members in industry and business with the help and support of her a team of resources. And we are having Mansur Awaji on my left, who has been the members in industry and is having the 20 years of experience, more than 20 years of experience since 1998, since 2008 in industry in the audit field. And all the respected members who are with us from each and every part of the country and outside country. I'm really very happy that we are having this very, very important topic today. We are very well aware that as far as the new Income Tax Act 2025 is concerned, I think it is going to be a game changer for our profession, for trade and industry, for our economy, and in turn for our great country, Bharat, and our chartered accountants, whether they are into industry and business or whether they are in practice. I think they are having great contribution in the field of income tax for trade and industry. And this topic today, capital gains tax issues in income tax assessments, appeals, and capital gains provisions under Income Tax Act 25 is very, very relevant. And I'm quite confident that all of you must have enriched in a great way from the deliberations and the question and answers you have asked and responded by Bimanshu Kansalji. Friends, you must be very well aware that committee for members in industry and business is comprising of around 60% of total membership. Around 3 lakh chartered accountants are there as a member in industry and business. And we are trying our level best to see that how we can outreach to them. We are organizing n number of CFO programs, outreach programs, RRCs. We are having and number of webinars. Every week we are having the webinars for our members in industry and business. And you will be very happy to know that we are at present we are having more than 150 industry study circles. I will urge to all the delegates who are with us that if you are having 20 or 25 members in your respective company, then we can very well have the CP study circle in your respective company. And we will be handholding in a great way, and we'll try to see that how we can have physical programs, virtual programs, and you yourself can also have the CP programs in your respective companies. Very, very easy procedure is there. I will request Anita ji to each and every member who is present today, how we can send through email or WhatsApp the requisite formalities, the requisite forms for that particular purpose. We want to see that we should have our brand ambassadors everywhere in each and every company and industry. We are organizing industry-specific programs for the Reliance Industries Limited. We are organized last year also, and this year also we are having training programs for the Tata key managerial persons of the Tata group. We organized last year also very, very prestigious programs. Dr. V. Sahuja was there. So we'll certainly like to see that how we can really do something very, very concrete for the members in industry. We are having CFO forums, executive development programs, industry-oriented webinars, global CA industry connect. You are very well aware that we are having very, very prestigious ICI awards. And in addition to that, 40 under 40. So we are launching ICI awards and 40 under 40 awards. The chartered accountants, young chartered accountants up to the age of 40 years, we identify 40 such chartered accountants. I will request all of you to disseminate that knowledge, that thing to each and every one, so that we can identify the best of the chartered accountants who have contributed in the best possible manner in industry. And you are very well aware that as 80%, more than 80% of our young chartered accountants are joining industry. So we are working in a great way to see that how we can handle the newly qualified chartered accountants also. And we are trying to outreach to them in the best possible manner. I will not be taking your further time as we are already, I think, close to the end of the program. So I am once again very, very grateful to all of you, CA Advocate Bimanshu Kansal sir, CA Mukul Singhal ji, CA Anand Vora ji, CA JK Jain sir, CA Mansu Agrawal ji, and of course CA Anita Suneja ji and her entire team for being the part of this very, very important webinar. Thank you very much, Anand ji.
Thank you so much, Chairman sir, and thank you for your presence in this webinar and for the kind words shared by you. We will take the webinar ahead with question and answers now. Himanshu ji, I will be taking the questions, further questions.
Sure.
Himanshu ji, if we can be very brief, so because it is already 5. It's already 5. So please try to conclude at the earliest, because then we are having the vote of thanks also. Thank you.
Sure. Thank you so much. Himanshu ji, the next question is, what are the major changes in respect of capital gain if we compare it with the previous income tax act?
So we can stop these questions which I have already answered. So
Okay.
as I mentioned, just to answer this question, as a policy, there is no as such change in the capital gain taxation, because the intention of the government is to keep the provisions same. However, we will see that what is the language, just to make the language simple, what can be the interpretational issues that we will see in future. For example, I have taken one example in relation to 50C. Another example which we can see in relation to section 54 also. So there can be certain interpretational issues just because of language has been simplified. Otherwise, intentionally and policy wise, there is no major change until unless there are certain changes by way of Finance Act 2026, which I have already covered there.
Okay. Next question is, why are the villas not charged under PGBP, profit and gains from business?
No, I mentioned that villas are to be charged under PGBP because intention is to keep it as a business income. So if there is any agricultural land and villas are constructed on that, that should be taxable under PGBP.
Okay. Next question is, for determining the duration of holding of land, which date is considered as start date? Option 1, payment of full consideration except stamp duty and entered agreement to sale, or second option, execution of sale deed.
So somewhere the same analogy need to be applied while determining the date of acquisition. So as we analyze the date of transfer, so somewhere I need to see at what stage I have taken the rights into land and building, when I have taken the possession. So these are the factors while analyzing cost of the date of acquisition also, and that is a very good and relevant question, because somewhere we see that what is the date of transfer, but simultaneously we need to see what is the date of acquisition also. So same principle we need to take into consideration.
Okay. Next question is, what happens if agricultural land is sold by its owner, but the purchaser is developing villas or plots? Will the seller be paying capital gains tax?
Yes.
Okay.
Seller will be liable to pay capital gain taxation in this case, because I have taken this into consideration during deliberation that developer is also having rights, which is intangible asset, and that will be taxed under capital gain tax. And the owner who is having land, who is the owner of land, so he will also be liable to tax under capital gain tax.
Okay. If investment is made in an under construction flat within the prescribed time limit to save the capital gains on sale of a residential property, and possession is taken within that time limit, but registration has not been made, whether the tax can still be saved?
Yes, tax can be saved, because in that scenario, somewhere a plea can be taken that the capital gain amount has been utilized by the assessee. By way of certain circumstances, unavoidable reasons, the registry cannot be happened. But ultimately, if assessee has invested that capital gain into property, that shall be tantamount to deduction under section 54. And for the benefit of participant, I just want to mention that section 54, 54F, these are very liberal sections. So if assessee is fulfilling the conditions of 54 and he is actually investing the money, then in that scenario, it is the matter to to bring the fact before the assessing officer to present the facts in the drafting, in the submissions. Otherwise, there are various judgments which support the direction under section 54.
Okay. Next question is, can 54F exemption apply to purchase of second residential house or apartment? If the capital asset is foreign shares, will provisions of section 54 apply?
I believe so that in case of sale of foreign shares, the provision of 54F will not be applicable because in section 54F, a specified asset has been defined and which says the shares issued by Indian entity. It practically happens in today's era that there are various employees who are working with MNCs and they are getting RSU or ESOP by the parent entity of their employer. So in that scenario, if they are selling those RSU or ESOPs, so what they will be eligible to claim deduction under section 54F or not. So somewhere this is the matter of further analysis. Apparently, the deduction should not be applicable in this scenario 54F.
Okay. Sir, due to time constraint, I will be taking last three questions. We have actually received a lot of questions from participants, but due to time constraints, I am taking last three questions now. So next question is, a property is purchased in the name of my wife, but payment is made 50-50 by husband and wife. Even home loan is also repaid equally. In case of sale of such property, whether capital gain will be divided or will be paid by wife only?
No, in that scenario, capital gain will be divided in two parts.
Okay, it will be divided between the husband and the wife. Okay. Next question.
Sorry,
Clarification.
what? Sorry,
I will repeat the question, sir.
in this question itself, how you started that property?
No, property is purchased in the name of wife, but payment
Yes,
is made
please.
50-50. I will repeat the question, sir. A property is purchased in name
So
of wife.
somewhere since the yes, I understood. I understood
Okay.
the question.
Okay.
So somewhere, as far as the owner of that property is wife only. However, the loan is taken in joint name. So first of all, I am surprised at how the bank has given the loan under joint name, because property is owned in the name of wife itself. But if that is the scenario, so ideally since wife is the owner of that property, then capital gain would be taxed under her end itself.
Okay. Okay. Next question. One listed company is liquidated and shareholders are not paid anything. Whether the loss in hand of shareholders will be capital gain or capital loss?
So capital gain will be should be read as capital loss also. So there is no distinction. There is a case of capital
Consulji, the voice is not
gain,
clear.
then the case can be capital loss also. So if the
Consulji, your audio is not clear.
need to pay capital gain tax, then he can claim capital gain loss. Capital loss.
Consulji, I think so your audio was not clear, so we were not able to hear the answer. You can hear us?
Okay, so what I'm saying that the court has interpreted, I believe so that in this question, only the point into consideration is capital gain or capital loss. So somewhere court has interpreted the case can be of capital loss also. So if assessee need to pay tax on capital, I just repeat. So I'm saying that equivalent to capital loss also in case of loss in any capital gain, then he will be eligible to claim. So okay, Hello.
Yes, sir. You are audible now.
Okay, I just
Yes, sir. You are audible now.
okay.
We got that
so
capital loss will be considered in this case, right?
right.
Okay. We'll move on the last question for the day. It would be clarification on capital gains on joint development agreement for reconstruction of existing flats. When does the transfer actually take place? Flat owners receive a new flat, no consideration given. How to treat the rentals that the builder pays and how to show it in the ITR.
So somewhere in the case of a joint development agreement, so there is an arrangement between the owner and the developer. So the transfer will take place at the time of receipt of sale consideration in that scenario. And again, you need to see that when the rights in those flats which are constructed by developer have been transferred. So if I talk about the taxability from both assessee perspective, one is developer and second one is the owner. So in case of owner, the moment when he is giving the developing right to the developer, that is not the stage of capital gain taxation. Actually, when these flats will be sold and consideration will be received, at that stage, capital gain tax will come into picture. Similarly, from developer perspective, there can be two scenarios. One is that developer is transferring his developing right to another person. So at that stage, capital gain tax may come into picture. Or another scenario is that when those developed flat will be sold and he will be getting sale consideration. It may be the scenario that developer may get the developing rights, and that stage itself he will be getting amounts from the owner. So in that scenario, that will be the stage to make it capital gain taxation.
Okay. So
So
thank you,
in
sir.
nutshell,
Sure, sir. Please go ahead.
in nutshell, we need to see that when the rights have been transferred and when the amount is received in this scenario.
Okay. Sure. Thank you, sir, for patiently addressing all the queries. With this, we come to the end of the today's interactive session. And now I would like to invite CA Mukul Singhal, sir, to deliver the formal vote of thanks. CA Mukul Singhal is a chartered accountant with over a decade of experience in audits of PSUs, banks, and large corporates. He is DISA qualified, ICAI peer reviewer, and co-opted member of the committee. Over to you, Mukul, sir.
Thank you, Anandji. Good evening, everyone. I, CA Mukul Singhal, have the pleasure to conclude this wonderful session with a sincere vote of thanks. First, I want to say a huge thank to our chairman, CA Dr. Anuj Goyal, sir. Thank you, sir, for your amazing leadership and for always bringing us such important topics. It is your vision that makes this session possible. I also want to thank to the entire CMB committee. Organizing a webinar like this takes a lot of hard work behind the scenes and have done a fantastic job today. I also want to thank our learned speaker, CA Bimanshu Kansalji. Thank you for making the complex world of capital gains so easy to understand. I also thank CA JK Jainji and CA Anant Voraji for their time and for guiding the session so well. Finally, thank you to the technical team and to all of you for joining us today. Thank you all. Have a great evening.
Thank you, Mukulji. So thank you so much, all the dignitaries and participants for attending this webinar. Recording and presentation of this session will be available on ICAITV.com.
To Chairman Sir and entire committee.
Yeah, I would continue it from here. Thank you so much to all the dignitaries and participants for attending. Recording and the presentation of the session will be available on ICAITV.com. We would be ending the session now. Thank you so much, everyone.